Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Analyzing financial statements and ratios. Analyzing financial statements and ratios is a crucial component of strategic financial planning, enabling businesses to align their financial health with their strategic goals. Financial statements provide a snapshot of a company's financial position, performance, and cash flows, while financial ratios offer insights into various aspects of the company's operations and help in comparing its performance with industry benchmarks. Together, these tools facilitate informed decision-making and long-term strategic planning. Financial statements consist of the balance sheet, income statement, and cash flow statement. The balance sheet provides a summary of a company's assets, liabilities, and shareholders' equity at a specific point in time. It is based on the fundamental accounting equation: assets equals liabilities plus shareholders' equity. This equation ensures that the balance sheet is always balanced and provides insights into the company's financial structure and liquidity. The income statement, or profit and loss statement, outlines the company's revenues, expenses, and profits over a specified period. It highlights the company's ability to generate profit from its operations. The cash flow statement, on the other hand, presents the inflows and outflows of cash, categorized into operating, investing, and financing activities. This statement is crucial for understanding the company's liquidity and how it generates and uses cash. Analyzing these financial statements involves examining the figures and trends to assess the company's financial health. For instance, an increasing trend in revenues over multiple periods indicates growth, while a declining trend in expenses suggests improved operational efficiency. However, these figures alone do not provide a complete picture. Financial ratios come into play by offering a more detailed analysis of the company's performance. Financial ratios are calculated by comparing different figures from the financial statements. They can be categorized into liquidity ratios, profitability ratios, leverage ratios, and efficiency ratios. Liquidity ratios, such as the current ratio and quick ratio, assess the company's ability to meet short-term obligations. The current ratio is calculated by dividing current assets by current liabilities, while the quick ratio, also known as the acid test ratio, excludes inventory from current assets. These ratios help in evaluating the company's short-term financial stability. A current ratio of less than 1, for example, may indicate potential liquidity issues. Profitability ratios, including the gross profit margin, operating profit margin, and net profit margin, measure the company's ability to generate profit relative to its sales. The gross profit margin is calculated by dividing gross profit by net sales, indicating how efficiently the company produces goods or services. The operating profit margin, derived from operating income divided by net sales, reflects the company's operational efficiency. The net profit margin, calculated by dividing net income by net sales, provides insights into the company's overall profitability after accounting for all expenses. High profitability ratios typically signify a healthy and competitive business. Leverage ratios, such as the debt-to-equity ratio and interest coverage ratio, evaluate the company's financial structure and its ability to meet long-term obligations. The debt-to-equity ratio, calculated by dividing total liabilities by shareholders' equity, indicates the proportion of debt financing relative to equity financing. A high debt-to-equity ratio may suggest higher financial risk. The interest coverage ratio, derived from dividing earnings before interest and taxes by interest expenses, assesses the company's ability to pay interest on its debt. A low interest coverage ratio may indicate potential difficulties in meeting interest obligations. Efficiency ratios, including the inventory turnover ratio and accounts receivable turnover ratio, measure how effectively the company utilizes its assets. The inventory turnover ratio is calculated by dividing the cost of goods sold by average inventory, indicating how quickly the company sells its inventory. A higher inventory turnover ratio implies efficient inventory management. The accounts receivable turnover ratio, derived from dividing net credit sales by average accounts receivable, assesses the company's ability to collect payments from customers. A high accounts receivable turnover ratio suggests efficient credit management. To illustrate the practical application of financial statement analysis and ratios, consider a hypothetical company, XYZ Corp. XYZ Corp's balance sheet shows total assets of $500,000, total liabilities of $300,000, and shareholders' equity of $200,000. The income statement reveals net sales of $1,000, cost of goods sold of $600,000, operating expenses of $200,000, and net income of $100,000. The cash flow statement indicates net cash from operating activities of $150,000, net cash used in investing activities of $50,000, and net cash from financing activities of $30,000. Analyzing XYZ Corp's financial statements, we calculate the current ratio by dividing current assets of $200,000 by current liabilities of $100,000, resulting in a current ratio of 2. This indicates that the company has adequate liquidity to cover its short-term obligations. The quick ratio, excluding inventory of $50,000 from current assets, is calculated as $100,000 equals 1.5, further confirming the company's strong liquidity position. For profitability analysis, the gross profit margin is calculated by dividing gross profit of $400,000 by net sales of $1,000, resulting in a gross profit margin of 40%. The operating profit margin, derived from operating income of $200,000 divided by net sales of $1,000, is 20%. The net profit margin, calculated by dividing net income of $100,000 by net sales of $1,000, is 10%. These profitability ratios indicate that XYZ Corp is generating substantial profit from its operations. In terms of leverage, the debt-to-equity ratio is calculated by dividing total liabilities of $300,000 by shareholders' equity of $200,000, resulting in a debt-to-equity ratio of 1.5. This suggests a balanced financial structure with a moderate level of debt. The interest coverage ratio, derived from dividing EBIT of $200,000 by interest expenses of $20,000, is 10. This high ratio indicates that XYZ Corp can comfortably meet its interest obligations. For efficiency analysis, the inventory turnover ratio is calculated by dividing the cost of goods sold of $600,000 by average inventory of $75,000, resulting in an inventory turnover ratio of 8. This indicates efficient inventory management. The accounts receivable turnover ratio, derived from dividing net credit sales of $1,000 by average accounts receivable of $125,000, is 8, suggesting effective credit management. By analyzing XYZ Corp's financial statements and ratios, we gain a comprehensive understanding of its financial health. The company exhibits strong liquidity, profitability, and efficiency with a balanced financial structure. Such analysis is critical for strategic financial planning, as it provides insights into the company's strengths and weaknesses, enabling informed decision-making. To conclude, analyzing financial statements and ratios is an essential practice in strategic financial planning. It enables businesses to assess their financial health, identify trends, and make data-driven decisions. By understanding the intricacies of financial statements and utilizing various financial ratios, companies can align their financial strategies with their long-term goals, ensuring sustainable growth and success. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.